It's a very special honor to welcome our next instructor here at European Investing Summit 2017. We have Stuart Mitchell joining us from London. Stuart is the managing partner and CIO of S.W. Mitchell Capital and the investment manager of two funds, the S.W. Mitchell European Fund and the SWMC European Fund, as well as a number of managed accounts. Prior to founding SWMC in 2005, Stuart was a principal, director, and head of specialist equities at J.O. Hambro Investment Management. While at J.O. Hambro Investment Management, Stuart managed the JOHIM European Fund, which rose by 133% since inception in December 1998 until March 2005, which compares to an 8% return for the benchmark. Similarly, upon leaving university in 1987, Stuart joined Morgan Grenfell Asset Management and was responsible for the continental European equity assets of MGAM's British pension client funds. Stuart was appointed a director of MGAM in 1996, and he was head of European equities, where he was responsible for $27 billion of equity assets. Similarly, the fund that he managed at that endeavor, the Morgan Grenfell European Fund, rose by 123% from January 1990 to June 1996, which compares to an 85% return for the appropriate benchmark. We are truly honored that Stuart has chosen to be with us and share with us his wisdom. Stuart, thank you for being here, and I welcome your comments.
The honor is all mine. It's a great privilege to be working with MOI Global and to be speaking at this wonderful European Investment Summit that you've put together for 2017. It's a great event, and it's really a privilege and honor for me to be invited to talk to you. What I wanted to start to do is just to say one or two words about our little business, and then to go on to focus on our investment idea. As you can see, I've got a picture of a Scottish landscape here. I'm Scottish, and we're all very proud of, I think, some of the characteristics, the innate personality traits of Scots. And some of those character traits come through very strongly in the way we think about and the way we manage money. We have a very long-term approach. We think value. We work hard, we nurture the people in our organization. We've had pretty much no staff turnover since we set up. The majority of our clients we've had now for 20 to 30 years. The whole mindset of the place is long-term value, stability, excellence, and that really permeates in everything we do. We managed $2 billion at the moment. We have a team of 17 people, 8 who are analysts, and then we have 3 in our marketing team, and the rest of the staff are involved in day-to-day operations. We made the decision at the very beginning when I set up the company back in 2005 to outsource our whole back office function to minimize distraction so that the focus of the organization, the office here, could be purely on investment and generating great returns for our clients. So maybe I can go on to just say a little bit about how we do it and the way we think and our approach to investment. And for us, everything is about potential. We're trying to find undervalued franchises, value opportunities that the rest of the market hasn't been able to do. And our day-to-day approach is all about meeting companies, visiting companies. We do some kind of screening work, but we found the most effective thing is to be on the road, crunching numbers, meeting companies, meeting competitors, suppliers, to try and find unusual opportunities. The company we're going to talk about is very typical of what we do that. We're very unconstrained. We don't think about benchmarks, indices. We run tight portfolios, 25 to 30 positions maximum. We do turn over our portfolios much. When we buy a stock, we're thinking about 2, 3, 4, 5 times upside potential. So often a position can be in the portfolio for 10, 15 years or so if the company continues to perform as we expect and as we hope. Maybe just to kind of touch on that kind of Scottish picture at the beginning again, consistency, stability, long term. We've always done it in the same way, going right back to Morgan Grenfell days. Most of the team have worked together our whole time. 3 of us have now worked together for 30 years, which makes me very old. And we have another 3 of us who worked for 20 years, and everyone else we've taken from university and nurtured. And as I said, we've had basically no client staff turnover since I set up the business almost 13 years ago now. And again, as I said, just to reiterate, most of our clients now we've had now for 20 years ago. We've been very fortunate. It's a kind of virtuous circle. We have these clients been with us for a long time. We have a group of people who work together effectively. So we have the courage, we have the kind of the context to be able to think in a very long-term way, value-driven way. I mean, this is a little bit about us. I was already very generous. I mean, this just tells you a little bit more. As I said, I was at Morgan Grenfell and J.O. Hambro. I'm very fortunate, had a very traditional career, And I've been very lucky all the places I've worked. Anyway, getting on to the real meat of the discussion, just to talk about this is a typical S.W. Mitchell capital stock, AP Moller-Maersk. And it sounds kind of familiar, it's a household name. How can it be valued in something like this? Lots of analysts trawling over the company. But the opportunity asked really came out of the China crisis. And when I say China crisis, the slowdown in growth that we saw post that very rapid period of dramatic investment in buildings and infrastructure. And then we had this period, I guess, 2013, 14, 15, 16, when that area of the economy cooled somewhat. And of course, that creates a perfect storm for a very cyclical company like Maersk, because they're in the container shipping world. And on the back of the China boom, post the 2007 financial crisis, a lot of new ships were ordered. And so in true shipping fashion, we had a moment really last year where we had an enormous amount of ships which came on stream, which were ordered in the middle of the boom 3 or 4 years back. At the same time, global trade slowing down somewhat, in particular all the work around infrastructure development in China. And it meant that shipping rates collapsed precipitously. And on the back, we saw a dramatic decline in the share price. And that's when people like us get interested, because everything we do it's all about potential. It's all about trying to find the value of a franchise. And if we think of a cyclical company like this, their market position has been undiminished through a difficult cyclical downturn, we think we've got an opportunity, because then we can try to model and think about the kind of returns that business might be able to make in the upturn. And of course, as you know, AP Moller-Maersk are the largest container shipping company in the world. It's a very nice position. They've historically been pretty much the only container shipping company to generate substantial returns over their cost of capital over a kind of long 20, 30-year time periods. And there are very few other companies who have been able to do that. So we have this nice opportunity. We have a terrible downturn in the interest, share prices collapsing, and then we're looking for one or two things. We're looking for a bit of a turn in the market to get our entry point. And the first thing, of course, to look at is the cycle. And this just tells you a little bit more about the business. I mean, you all know the business. It's Maersk Line, which is 21 billion of revenues, and they have this oil in the terminals business and Damco in transport and logistics. And then they have the energy side, which I'll talk more about later, which was a kind of diversification. I guess they've got involved with in the coming out of the to try to balance the business against the container side. But this is the critical thing. We see the market beginning to tighten. And that's so important, because then we can start to see a bottom to the market, a turning point of the market. We can start to begin to think about rates rising and the cycle moving more positively, and the market can begin to think about what returns could be like in a normal cycle. And this just shows you the SCFI index excluding fuel costs, which gives you the real underlying move in the index. And you see the collapse down to 2016, and then the thing has begun to pick up and it's come off a little bit. But the beginnings, it seems, of some kind of a turn and stabilization. And the critical thing, of course, is that collapse in rates in 2016. It meant that the operators are much more reluctant to order new container vessels. And there's a rather nice little chart. If you look at the left-hand side, you can see quite big orders in 2013, 14, and 15. And then they just kind of disappear from January 2016 to 17. And quite nice, it's even better if you look at it on the right-hand chart. This is new orders as a percentage of the current fleet. And you can see that extraordinary number, the Chinese boom. If you look at 2011 to 2012, you go to 20% of the current fleet in new orders. And of course, global trade was growing very fast. But again, that's a really big number. And then, of course, we have another big surge, 2014, and we have 2016, big numbers. And then it drops off dramatically. So new orders for the fleet coming in 2016, and we think most of those orders will be cancelled anyway, or delayed so as not to have an impact. And of course, this is the other way to look at it, is to actual deliveries rather than orders. And you can see deliveries starting to come down as a percentage of the existing fleet. The one number I quite like to look at is deliveries as a share of existing fleet capacity, only dropped below 8% since the beginning of 2016. That's kind of pretty interesting. It's a long time it's been running at new deliveries running substantially above 8%. You had a little drop around about 2000. And of course, world trade has been kind of growing at that rate. That's been absorbable. But then when you had the slowdown in China post the kind of boom as a response to the financial crisis in 2007, you see that the market getting out of balance. And then there's a very nice drop, which I've circled at the end, where delivery is now down to a much lower number. And they will come down to something like 0 if we were to push that chart through to next year. And so, of course, the other part of it, that's only just one side of it. It's kind of orders and the response to the crisis. And you've had Hanjin going bankrupt and the operators freezing up on orders, facing all sorts of pressure on their balance sheets. And But the other part, of course, is scrapping, and this is a really nice one. Scrapping has picked up dramatically, and quite a lot to do with that is with the age of the fleet, older ships, inefficient ships, and also a big chunk of ships coming up for their 20, 25-year reviews, and that's very expensive, and it can often make more sense, particularly where rates are at the moment, to have the ships scrapped rather than to go through the very expensive survey process and the refit. So that's a really nice number. Look how it's picked up from 2008, bobbing along when the industry was buoyant, very, very buoyant, lots of new ships. And then you've got this age effect now. You've got these ships which are ordered back at the end of the 1990s are now coming up their 20-year anniversary. And so scrapping beginning to pick up very substantially. And 4% is a big number. So you've got the whole kind of supply demand really beginning to look quite nice. You've got nothing new coming on, no new builds coming on. You've got scrapping beginning to pick up, and you've got world trade running it, picking up a little bit, running at pretty much the same rate it has been for the last few years. That's quite a nice little number, that. So then we look at this, the critical one, which really brings everything together. It's a change in nominal capacity of the global container shipping fleet. So this is all the effects of new ships coming on and scrapping. And now we've come down to zero, which is just kind of where we want to be. Nothing new coming on. So the market can start to tighten up on the back of continued global trade. And then we can get the beginnings of rates starting to move higher. And just quite a nice little chart that shows you it doesn't take much to bring the industry back into balance. Modest demand growth should bring the industry back into balance. We just need a few years of 2.5%, a year or so of 2.5% volume growth. We should see the market coming quite nicely, tightly back into supply demand sometime around about beginning of next year. And we're well on track to be able to do that. I think so. That's the first thing. So the cycle's turning, and value ideas are always challenging, as we know. We can see the value of this exceptional feat, which has generated better returns than anybody else with the industry. The franchise undiminished over the crisis, but you just want to see that beginning of a turn, a tightening up in the market, so the market can start to think again of recovery and the kind of earnings that the business could be generating in better times. But the other really fascinating part of it is the crisis, of course, has prompted a lot of soul searching at AP Moller. And one of the big problems with this share is that although it was very asset rich, it wasn't quite obvious why the business was so diversified. We all know they have excellence in container shipping, but it's not so obvious that they're the best people to manage energy assets. And one of the things which people like myself have always argued with them is people pay a discount to net asset value of this company because they feel it's a conglomerate structure. They don't feel that you're the best assets to run everything. They would love you. Your shares will be more expensively valued if you focus on just what you're best at doing and divest non-core assets. And this is what they're in the process of doing. We think this will be a further thing which will push asset values higher, which will make the investors rather focus on the rich asset value of the group and drive the share price higher. So this is just a very kind of little simple chart. It shows what they're doing. The first critical thing is the sale of the energy assets. Apologize for, but you would have seen the first sale of the oil business to Total for a very, very nice sum, slightly higher than we expected, over 7 billion euros. But there are the rig assets still to go and other bits and pieces. But it's a very nice start to that refocusing which they promised when they had the strategic review last year. The other thing is they said they're not going to further expand the ports business. Now the ports business is quite complementary to container shipping. It should enable them to optimize the fleet by owning a number of ports and strategic positions. And there should be the advantage of passing their own ships through their own ports. So it's not obvious that's a business that should be sold, but again, the group, and I think rightly, have realized that their real value, their real strength, where they're absolutely dominant is container shipping, and they should focus on this above all. And so the first thing they've done, and as part of that, is to buy Hamburg Süd, which is a very significant business running basically out of Latin America up into Europe, shipping route, which AP Moller were barely involved with in the past. And that just kind of continues to build the market share further. That's what they should be doing, selling non-core assets, focusing, building up further, making the company even stronger in container shipping. And we think will enable it to generate even higher returns on capital and the share to become more attractive to investors. And they have a plan, as you can see, also with a whole load of different reasons, with whether it's cost cutting, whether it's digitalizing the group, of retrieving the return on capital by 2%. And we find the valuation very compelling. I mean, there are all sorts of different ways we can do this. We can look at the value of the ships. We can do a kind of EV/EBITDA. We can look at the invested capital of the group. I think these are very reasonable ways of doing this. We look at EV to EBITDA, which is an interesting way of doing it. We come up with a certain number, or we can look at investment capital. and we can work it around that way too. An absolute kind of minimum share price we get is somewhere around about 15,000 Danish kroners, and it's around about 12,500 Danish kroners today. But in a more buoyant cycle, considering what the price of new builds will be, because when the cycle begins to really gather momentum again, 20,000 Danish kroners would be a reasonable valuation and wouldn't look out of kilter, using traditional EV/EBITDA multiples, say in 2020 when the cycle is more progressed. Or looking at the value of that invested capital, because of course that investment capital will become more valuable for the next round of new builds and as the market tightens up. So we see a really nice, really significant potential. And you look at Maersk Oil, in fact, the valuation we had here, the sale through to Total was at a higher price than we had in our valuation metrics here. So we really see a significant upside. Maybe just a kind of last point, just to leave with our performance since I started running money, buying companies like Maersk and other kind of great value situation. Since I've been running money in the early 1990s until today, 27 years, I've made 20 times my clients' money, again, 6 times for the market. You can see the different funds. The Morgan Grenfell Fund, then as a transition period when I was setting up the new European Joe Haber European Fund, you can see those numbers. And then when I set up my own business, you've got the figures right up until today. So we've done reasonably well over time, very patient investment. The same group of people have been running money for right back to 1993 of us, right back until then. Jamie, myself, and Steve, right back 20 years ago until the late 1990s. We've always done it with the same approach, patient, long-term, little turnover. But Shai, that was what I wanted to say really as an introduction to the idea, and it'd be great if you've had any other thoughts or questions you'd like to raise at this moment.
Stuart, thank you very much for sharing such a fascinating idea. I'd love to please turn back to slide 3, if we could. I noticed language that you've 30 years experience investing in Europe, 1,500 annual company meetings. Could you elaborate what you're trying to avoid? Are there certain air pockets in Europe that these days give you pause?
It's a very good question. I was rather fortunate in a way because when I was thinking about leaving Joe Haber and setting up my own business, it was an opportunity with a clean sheet of paper to try and think, how can I organize myself to give me, this is the answer to your question, how do I organize myself, our business in a way to give us the best possible chance of creating fantastic returns? And one was the team we talked about. We've worked together for years, always done it the same way, great group of clients. But the other critical thing, which you focused on, picked up here, is we thought the best way to give us a chance of doing it was just to do Europe. It's the one thing we know about. And we felt, although in the short term it may have missed out on some opportunities in the US, particularly in the technology space in the early years, but it seemed to us that the one thing we really know about is Europe, and we've just got to stick to that. So the other part is the 1,500 companies a year. I mean, that's a really interesting one. You know what it's like value investing. There aren't that many opportunities. So this maybe look like a kind of a big number of companies that we're seeing every year. But most of our companies we'd see at a minimum 8 times a year. So we'll talk to them at the quarterly results, and we'll probably talk to them once else in the quarter. And then there'll be a whole load of meetings around about that when we might be speaking to a competitor, a supplier. That's why the number looks so big. At the end of the day, we're probably only making 2 or 3 investments a year, 3 or 4 investments a year. So it's a lot of ground the 8 of us are covering to be able to find those opportunities.
I'd love to kind of stay on this point for a moment. As a domain expert who has geographic domain expertise, do you see any mistakes that come up among people who are more generalist or people who are perhaps amateur?
It's a really, really good question. It's a difficult one to answer because I know some friends of mine have become global money managers and they've done very well. And they made that transition 6 or 7 years ago, and just by having some stocks which weren't European, and even by having 2 or 3 of the better known US names, you would have dramatically outperformed because that market has done better than any other market in the world. My guess though is longer term, it's going to be hard because I just think to do well in a market, you've got to be right in the DNA of companies. Unless you see a company, whether it's Siemens or Maersk or Nokian Ties or Yara, year in, year out, over and over again, it's difficult to be able to kind of spot those incredible entry moments. I think it's only by knowing a company for years that you can have the courage when everything looks to be going wrong. Like ST Microelectronics was a big position of ours, somewhere near bankruptcy when we bought it. But we could see through all that because we followed them for years and years. We could see the value of the businesses behind the problem areas, and we were able to invest. And I just think that's difficult to do if you try to do everything. And people who have done it recently have done well. They've chased momentum, they've bought the tech stocks, and they've done incredibly well. Whether that's an approach which will get a market which will become more critical when rates begin to rise a bit, whether that's an approach which will continue to work well, I just don't know. I mean, I'd be interested in your thoughts on that, Shai. It's a really difficult question.
If we could turn to slide 6, please. I'm curious,
Yeah.
is there actually competitive advantage by having multiple segments?
It's a very good question, and it's not entirely obvious. I think if you're going to be brutally honest, it probably, as the way things are at the moment, and the last 5, 10, 15 years, it probably hasn't been an advantage. I mean, there are arguably better competitors than Damco, people who have just kind of perfected that whole business. There are arguably better terminal operators. I mean, our guess, and this is quite interesting because, as you know, the new chairman of the company comes from the SAP group. Our guess is that this could be the moment when that being in all areas starts to become a benefit, although it's still not entirely obvious. I think the pressure is to be more and more value added. And if they can somehow integrate the whole thing into a very slick digitalized offering, and that's hopefully what the new chairman with his SAP background can bring. APM terminals, there are other people who operate terminals much more efficiently, and likewise in Damco, there are great freight forwarders who that's all they've done is just kind of picking the stuff up from the container and then being very clever about operating fleets of lorries and using the rail network. It's a very good question.
What freight forwarders particularly impress you, ignoring valuation?
Cooney is a really nice company, and they've just done very well over time. My colleague Jamie Carter has done a lot of work on them in the past. It's a little bit smaller, and they seem to have been able to generate over time a very attractive return on capital. There's that single-minded focus.
If we could move to slide 9, please. I'm noticing that the chart seems to repeat itself. Can you speak a bit about how history might rhyme?
Yeah, that's the kind of the bare point. It's this is a brutally competitive industry, and none of the operators want to lose market share. So the moment that the cycle starts to be turning higher, then people start ordering ships again. My guess is, looking at the financial state of the major competitors, looking at the brutality of the last turn, the bankruptcy of Hanjin, my guess is they'll wait a little bit longer before they order. And of course, new orders made today, it's going to be 2 or 3 years before deliveries can be made. Our kind of hope is that we have a kind of a phase rather like kind of 2007, 8, 9, 10, when orders were very minimal after the great financial crisis. I would hope that we have 3 or 4 years before we have the spike again. But it's a great question. It's the risk, it's the danger in this industry. The point we can make, though, is that by being the best and most efficient and having the youngest fleet and somehow coordinating their activity, being full as they go out and full as they return, the boat being a higher occupancy than their competitors, Maersk, of all people, should be able to generate significant percentage points above their cost of capital as they have done in the past.
Slide 10, if we could, please. I'm noticing quite a few sources for the chart, Clarkson's, Alphaliner. If you could speak to any other data sources you found value add, these are some great references.
Well, Maersk being the largest, they have a whole load of great charts. Probably use some of them in the presentation as well. They provide a great amount of data. I guess it's more objective to use Clarkson's because they are the kind of gather of information, and all of us will get information from Clarkson's.
Assume I don't know anything, which is the case. What is Clarkson's?
Clarkson's is an interesting company. It's both a shipping broker and based in London and very successful. But also they have a research arm as well. So they provide all the kind of critical stats for the industry. So they'll know as well as anybody else about new orders, about the number of ships in everyone's fleet, about supply demand. They'll gather all the kind of the freight rates around the world. So it's an excellent kind of, I guess, research service for people interested in the shipping market. And then Exxon BNP, one of our favorite external analysts we use, who's done a great deal of work in the industry. And we always, when we do work like this, particularly when it's in a kind of complex area like shipping, we always like to kind of bounce off our ideas against somebody who's been doing that job for a long time. And so he was somebody whose research we appreciate. It was enjoyable to be able to bounce ideas against him.
Technology is helping increase the utilization rates of cars. One car could be more efficiently optimized. Is there a similar dynamic where shipping assets could be better utilized over time?
Well, this is a very difficult one too, because most people like you and I no, shipping is just being a brutally competitive industry, and there's all sorts of kind of crazy people coming in for different reasons. It could be government funded, and the moment the market gets a little bit better, you get dumped with a whole ton of extra capacity. Now, our hope is that that's beginning to change, and when we have these great kind of, as it were, these kind of agreements where groups of shipping companies are operating together to try and make the market work in a more oligopolistic way. We think that'll help, but we think the other part, which should be able to help, is your digital point. And that was crucially why the new chairman of the group came from SAP with that digital internet knowledge. And there must be an ability to make this whole, because it's a pretty basic industry, there must be ability to kind of make it more efficient and digitalized, and to be able to increase the utilization of the ships in a more clever way. And that's all about sharing information and making it easy to get onto book space on a ship. That's what the process is trying to do. On that chart, when I showed about AP Moller-Maersk kind of changing the way they do things and selling off the non-core assets and becoming even bigger in the industry, buying Hamburg Sud, the other thing which I kind of glided over really was they wanted to increase the return on capital employed by 2 percentage points. And a lot of that is all about increasing the utilization of the fleet, making it work just better and cutting costs. I kind of get that. If you listen to the chairman of the group talk, he's messianic and thinks there's an extraordinary opportunity to make this industry much more efficient. And it's something which is not really talked about by the sell-side analysts. They tend to be much more cynical.
And I think building on that same question with slide 11, if we could, please. There's clearly been a scrapping, which implies that there's less assets out there to be utilized.
Yes.
I remember Frontline back in 2002. It sounds like a very similar setup, perhaps. And back then, the price of steel was a major driver of the scrapping rate. Can you talk through how steel prices impact the current sensitivities?
It is. It's not such a big deal now because, of course, the steel prices come down quite a lot. The calculation is much more the cost of getting through a 20-year survey or a 25-year survey and all the kind of the working on the hull that needs to be done. That's a more prominent, and of course, the kind of the scrap price of steel is important. But it's more about what will it cost you to get through the survey and make a kind of guess of the rates you're going to get. Does it make sense to make that investment? Or is it just to scrap, wait till the market gets better, and then to order some new builds?
I mean, I would imagine if the price of steel goes up, scrap rates might shoot meaningfully higher.
It should be a tailwind. Of course, the only trouble with that is it normally happens at a time when freight rates are going through the roof too. And so some ship owners are a little bit less reluctant, then cost of the refurb in relative terms becomes less important. So it's a complicated calculation.
And moving to slide 12, if we could, please. I'm sorry. This seems to be non-sustainable. Do you have any idea at what point the pressure just has to crack? Could this go on for months or years?
We would hope that we get 1 or 2 or 3 years, the global capacity stays around about stable. It's all we really need to get freight rates which would justify a new build. And by justifying a new build, it means that a new build order today makes something like a 15% return on capital, conservatively financed. So our hope is we get 1 or 2 years when we have basically zero growth in nominal capacity of the fleet. At the same time, we have decent kind of trade growth picking up to kind of 4 or 5 or 6% again. We should have a nice tight market. Rates should rise higher. They've been flickering higher than coming back, flickering higher and coming back. But our hope is that sometime from the beginning of next year, we should start to see a substantial increase in rates.
If we could jump to slide 14, please.
It's so difficult to model.
I'm noticing in the top left corner the sale of energy assets, and you mentioned there's a discount to NAV dynamic at times.
Yes.
I think you talk about this a bit farther on, but how do you think about the NAV value and how do you think about the NAV being monetized?
Well, it's a really good question because people are willing to pay full NAV for a business, which is where it's clearly the company has a competitive advantage, and container shipping, they're the largest in the world. It's something very special they do. They demonstrated over 20, 30 years, they've been able to generate a return on capital significantly higher than the rest of the industry. And I should have had dot diagram, but if you look at over the cycle, the kind of returns on capital, they stand out on their own and everybody else is somewhere down around about the 3 or 4 or 5% level. But the problem is, of course, is when you diversify, when you get into other areas, and clearly there are other people who are larger and more skilled we think, at managing energy assets than AP Moller are. I mean, they should really stick to running container shipping. So what normally happens is people like us, we look at a group like this and we say, well, wow, this is a great business, but why should we pay full asset value for this energy asset? Because if this energy asset was part of Total or Exxon or ENI, it would probably be a lot more profitable, only because if that asset's within a much larger group, you can amortize costs better. There are all sorts of advantages. Bigger groups should be able to yield a better return out of an energy asset than a smaller group like Maersk. And they wouldn't thank me for saying this, but playing around in the energy area, which isn't their principal core strength. So our hope is that what normally an investor like me would do, we look at the container assets and we do the work. We'd say, well, what would it cost to rebuild this fleet today? Put a value on it. We'll look at how much they've invested already, put some kind of multiple on that. We look at the earnings the business is generating, put kind of an EV multiple on that, play around with all sorts of different ways to get a value. But on the non-core stuff, we'd probably put a 30% discount to market value, because it's worth 100% if it's part of Total, but part of a group like BP Moller-Maersk is worth less. So when we hear of sale of energy assets, that kind of excites us, because we know that that value will now be valued at 100% rather than a discount.
And I'd love to focus on the language dramatic refocusing. Has there been a shift in the insider incentives or any other catalyst why they're doing this in 2017 and not 3-5 years ago?
That is a great question. I should know this, the new chief executive's payment package, and it's been explained to me. So I can't exactly remember the detail of it, but it's broadly around about generating a return on capital and being able to generate significantly above their cost of capital. And AP Moller have always been able to do this in the past. When the oil price was very high, of course, that was just an area which, when oil was $100, and also when the economy was booming before the great 2007 crisis. And I guess they were kind of lucky because the oil price remained high and container shipping remained, perhaps freight rates were continued to be at a level you might not have expected out of what happened, because the Chinese economy continued to be so strong. But of course, when the oil price collapsed and when freight rates fell too, it kind of brought about a whole load of soul searching, because for the first time in many years, this company wasn't able to generate the extraordinary returns they had been able to in the past. So that's what's led to the change. And it's big for them, because this is a business that was being built up by a family with a long-term view of many generations, and to have to cut something which you've put a lot of love and energy into, it's a big, big deal. But they were able to do it. And, and really think, wow, this is what we're best at doing. We're going to refocus back onto that.
If I heard correctly, you mentioned that the purchase of Hamburg Süd opens up a new shipping lane, if that's correct?
It does, yes.
What does that mean?
Well, Hamburg Süd is fascinating because it's a very significant acquisition for them. It's still not in the process of closing. It kind of helps in all sorts of different ways. They'll get the benefit of financing from AP Moller. There'll be all sorts of synergy costs they can strip out. There could be some top line revenue, there's some revenues they miss because where they're operating on the same routes, but again, that's not quite the same. It's not quite as significant as you might imagine, because Hamburg Süd really does operate largely on a different route than AP Muller's main areas. And so they go from Latin America up into Europe. And that's something which AP Moller hasn't got a significant market share in. So there'll be a little bit of revenue loss where they both operate on the same routes. And at the same time, the cost savings, the synergies should be substantial. And what we've done is we've looked at various other deals in the past where the similar thing has happened, and we've kind of made a kind of guesstimate for cost savings. We've put that to the company, and they've kind of suggested that that's not a crazy figure. This should really create value. I mean, the best way a company like this can create value is by buying more businesses in their area and cutting costs and integrating them into their network, rather than diversifying into business like rigs and energy, oil, where they're not the kind of the strongest and most profitable in the world.
If we can move to slide 15, please. There's a lot of data here to unpack. I would imagine that the energy economics might be rather stress tested and even trough at the moment.
Yes.
You're showing a 3 times multiple on what might be trough earnings power. How do you think about a private market transaction? 3 times might not be what it goes for in a private sale.
Well, Maersk Oil went for a little bit more than that, and in the end they got $7.5 billion. So that was a better price than many of us had been expecting. And you're right, maybe they could have been cleverer. Maybe they could have tried to wait for a higher oil price to sell the thing. But I think they probably made the right decision. It's a smaller part of the value of the group. And to be able to, that distraction, to be able to refocus on transport and logistics makes a lot of sense. But the big question is around about drilling, and drilling rates absolutely terrible at the moment. There's really not much of a sign of it. There's a bit of a pickup for super quality, brand new 6th generation rigs. These are the kind of the latest ones, $1 billion a piece, which can operate in very deep waters. But for the rest of the market, it's still very sloppy. So we really need activity to pick up in kind of the offshore, whether it's North Sea or whether it's deep water Gulf of Mexico or it's Brazil. At the moment, the only real pickup in activity has been shale in the US. But we need that to broaden out to kind of the area in which they're in, which is deep water. So my guess is they'll wait a little bit, and for it to get a better price, an opportunity to sell that is not such a big part of the NAV. It's a distraction, but we have the financial strength to wait for a better opportunity. In fact, we're looking ourselves at some rig companies as being very, very nice opportunities. If you can buy a rig now from a distressed yard, what you can pay is $1 billion price, and you can probably buy those assets now for $300 or $400 million. And even at today's distress rates, you can cover your capital costs and make a decent return. There's probably a better opportunity for them to sell those assets.
So just to clarify, what seems to be non-core is the 6% drilling asset as opposed to the 19% energy. What is the non-core component?
So non-core is oil, drilling, service, and tankers. So energy, sorry, this is very badly. Energy adds all those together. So energy adds together oil, drilling, service, and tankers together. And then transport and logistics adds together all the bits above: Maersk Line, APM Tunnels, Svitzer, Damco, and Hamburg Süd.
Terrific. And then if I'm trying to get a broad sense of NAV, how do I start to think about NAV?
It's a nightmare. It's really difficult. I think a pretty conservative one. You have a look at EBITDA. What do you think it's going to be in 2017? And then you do a kind of classic kind of EV to EBITDA multiple on those earnings. And then you take away all the other effects of long-term debt and other bits and pieces, and you get some kind of an idea of the share prices. 15,000 Danish kroners. My guess is that's a pretty trophy number. And in a slightly more buoyant economy with EBITDA picking up a bit and people paying a bit more for that EBITDA, my guess is you can get that up to 20,000 with not being, you don't have to be too enthusiastic.
If I could push back and be a bit of a devil's advocate,
Of course.
what would you consider to be a very draconian situation, and how it needs to massively stress test the assumptions?
Well, for them, there isn't the bankruptcy risk because they're very well capitalized, they're the large and best financed. So there isn't the kind of the zero risk. The one way or the other, they'll get through it at the other end. Most of the industry is running at basically cash break even at the moment. So our kind of guess is that we're somewhere near the bottom. I mean, having said that, the share price has been quite a lot lower than where it is today. So perhaps the kind of the stress test, we go through another, if growth falters in the States and we have something happening in Korea, then my guess is that we start to go down to kind of really kind of where the industry is losing money at a cash level. And that could be a share price of 1,000 or something, 10,000 rather. But the leverage isn't so significant on the NAV because they're not nearly as leveraged as many of the others. And remember, of course, this chart, they've sold off Maersk Oil. I think for some of the more leveraged Far Eastern players, the impact is really much more significant. But it's a great question. That's the trouble, in the value world, in our world. You're looking at great assets and you're kind of guessing about what those assets are worth in a more normal environment. And it's always a bit scary at this moment when the freight rates are still very low and there's lots of skepticism. Our thinking is that, this is a franchise which has probably grown stronger over the crisis. It basically follows capitalistic principles. Weak ones fall out. We think their kind of premium return on capital generation over the industry should be able to endure because they're the biggest and global and they manage to fill their ships better than anybody else. So our guess is they'll be able to one day be able to get back to those kind of returns on capital, discount that back to present value. And I think you get anything between 15,000 and 20,000 Danish kroners.
Can we please move to slide 17, please? I'd love to be a bit direct. What is motivating you to share your wisdom with us? You're being quite candid. What's in it for you?
I just love the whole business of discussing investment ideas. I mean, there's nothing more enjoyable than, say, at a recent seminar, sitting down with John and talking about, it could be Yara, or we're a community of people who just loves the whole business of investing. And that's kind of way more important than making money for our clients is everything. It's much more important than making money for ourselves. And I think that's kind of true for our whole community, really. We're a bit different than many other people in the investment world. Would you say that's fair?
Yeah, there's a very select group of people who want to share and learn, and clearly you're very much trying to share and teach. So we're very grateful.
And then, of course, I get the opportunity to listen to the rest of the other people talking at the European Investment Seminar. That's great for me. And I just kind of love looking at, love being kind of provoked by other people's ideas. And I get great ideas. Some of my best ideas I picked up from other people. I mean, when I complete, I'll take anything, like Picasso, well, not that I'm anything like Picasso, but his great thing was to steal other people's styles. And that's what anything we can, any other opportunity to make money for our clients.
So Stuart, if I could actually clarify, what kind of inbound feedback is most value add? So if people are looking to give back to you, what would you be looking for?
Well, what are things we've missed? We get it wrong a lot. And it's great to hear other people saying, Stuart, you're kind of completed it. You haven't considered this. Or Stuart, have you looked at another company very similar to this? Looks just as cheap. Why don't you have a look at it? We love all that kind of stuff. Or Stuart, have you considered this industry? It has the same characteristics as shipping. Have a look at it.
Terrific. And what's the best channel for people to give you value add feedback, please?
I mean, just fire me an email, and we really, it's great. We enjoy that.
Stuart, we are very grateful for all your generosity, and we can't wait to hear more from you in the future. Thank you for your time.
It's been a great privilege to talk to you, Shai. Thank you.